Hello and welcome to the exciting world of derivatives. Let's jump right into this. A share of Microsoft stock classifies as equity. A Greek government bond classifies as a fixed income security. The yen is the currency of Japan. Gold is a commodity. You might not know everything about equity or fixed income or currencies and commodities, but it's highly likely you've heard of them before. You probably have a vague idea of what they are. And the reason is because they receive significant coverage in financial as well as mainstream media. But have you heard of derivatives before? Unless you've taken a finance class in your life, it's not that likely you did. Derivatives are financial instruments that derive their value from the value of an underlying asset. Bear in mind that there are other ways to define derivatives as well. The main idea is the same though. So derivatives derive their value from the value of an underlying asset. That's why they are called derivatives. And this underlying asset could be one of these basic assets we just mentioned. As we will see later on, there are cases when it's not even an asset. For example, it could be an interest rate or even the weather. Interest rates and the weather are not generally perceived as assets. So in order to cover for the cases that it is not an asset, I could have replaced the word asset in the definition with the word variable. But it is so commonly the case that it is an asset that most finance textbooks define derivatives with the word asset. I decided to do the same. For now, just have in mind that it is not always an asset. But even if you forget about this, it will be a recurring theme as we progress, so you've got nothing to worry about. Let's now go through an example. Pratham Mehta entered into a contract that obligates him to purchase 10,000 shares of Tesla Motors stock for $250 per share on March 25, 2016. Assume there were no upfront costs at the initiation of the contract. In other words, Pratham, our investor over here, didn't pay anything to enter this contract, which means that his eventual gain or loss will be exclusively determined by Tesla's stock price on the date the contract settles, and that date is March 25th, 2016. So on March 25th, 2016, if Tesla's stock price is trading for more than $250 in the public markets, which is the same as saying in the stock exchange, then this contract will offer Pratham a gain. Why? Because by virtue of the contract, he would be able to purchase Tesla stock at $250 per share, a price lower than the market price, which exceeds $250. Therefore, if he were to go out in the public markets and sell his holdings in Tesla stock, he'd be selling at a higher price than the one he paid for, and he will thus be realizing the difference between the two prices as a gain. And I've written this down for you as well. Purchase at $250 and sell at a higher price, the stock's market price. Now if the stock price is lower than $250, this contract will provide Pratham a loss. Why? Because in an equivalent manner to before, he will be purchasing at $250 per share, a price higher than the market price, which is below $250. If he were to turn to the public markets to sell his holdings, he would be selling at a lower price than the one he purchased. He would thus be realizing a loss. Finally, if the stock price on March 25th equals $250, then Pratham would realize neither a gain nor a loss, because the purchase price of $250 would exactly equal the stock price, which is potentially the selling price. So it's as if he would be purchasing and selling at the same price. So this contract we went through is a type of derivative instrument. And if we were to remind ourselves the definition for a derivative, we would observe that it falls within that definition. We saw that this contract derives its value from the value of an underlying asset, and that asset is Tesla stock. We saw that the direction that the stock price moves will determine the value of the contract. if it will have positive value and thus provide a gain, if it will have negative value and thus provide a loss, or if it will have zero value and provide neither a gain nor a loss. I'll close this introductory video by saying that over here, I mostly aimed at getting you intrigued with derivatives. I kept things fairly simple by leaving out of the analysis complications such as transaction costs, which can affect the potential gain or loss. We will see those issues as we move on. Take care.